Hey everyone, and thanks for jumping back into the macroeconomics first. Today, we're going to talk about the yield curve. We're going to be looking at the S&P 500, the yield curve inversion, as well as unemployment, among a few other things. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So we certainly live in a day where essentially everyone on Twitter has now become an armchair economist, myself included. But I wanted to try to do a good job of explaining some of the things that I see going on in the markets, and hopefully it'll help you navigate the markets just a little bit better, or give you an outlook that maybe you didn't currently have. All right. So we're just going to be looking at the data, the information. I'm going to try to provide my interpretation of it. Of course, it is subject to to being, you could disagree with it, you could agree with it, but I just want to show you what I'm seeing in the market. So what we're going to start with is we're going to start with understanding risk on versus risk off. Okay. So one of the things we've said a lot on this channel is we talk about the idea of, are we in a risk on market or is it a risk off market? In a risk on market, a lot of people are investing in risk on assets like equities, stocks, and or cryptocurrencies. And the reason is because they are seeking yield. In fact, before cryptocurrencies, and still well after even cryptocurrencies had been developed, there are a lot of investors that operate with something called TINA, which means there is no alternative. And that's in reference to there is no alternative to investing in things outside of the stock market. Because simply put, if you want to find yield, historically, or at least for the last decade or so, you're hard pressed to find good yields outside of risk assets, and that's why a lot of people just poured money into the stock market and pour money into cryptocurrencies, and that would be considered a risk on time, exactly what we saw happen over the last couple of years in 2020 and 2021. But you can also have risk off times where investors might be somewhat wary to put a lot of money into risk assets because of somewhat concerning macroeconomic conditions. And remember, investors or the market does not like uncertainty. And so investors don't really like uncertainty, because if there's a lot of uncertainty in the market, then investors might be spooked and they might go elsewhere. Now, for a long time, interest rates have been relatively low. And the Fed has kept interest rates at basically near zero for quite a long period of time. But what you'll see recently is that the 2-year yield right now on U.S. government bonds has catapulted itself up to over 3.4%. And in fact, as I'm making this video, it's currently sitting at about 3.425%. Now, the reason this is important to follow is the higher this goes, there's a higher and higher likelihood that investors might say, well, wait a second. Why would I put my money into risk assets if I'm concerned about them losing 5 or 10% over the next year or whatever it might be, when I can go get 3.4% APY, again, relatively risk-free, right? I mean, there's no such thing in reality as risk-free, but this is relatively risk-free compared to a lot of other things. So, if this is coming in at 3.4%, that is money that investors can say, well, look, I don't necessarily want to deal with how bad the macro looks, and I don't want to deal with that uncertainty. What I might do, I'm speaking as a theoretical investor, is say, well, why don't I just go ahead and put some money into some of these bonds or whatever it might be. And the reason, again, is because I just want to wait and see what the macro does. Do things look better? And we're currently looking at 2 years, but there's a whole yield curve, and you can actually plot it relatively easy in TradingView using just a little bit of Pine script. And what you have is I have on here the 1 month, 2 month, the 3 month, the 6 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, and 30 year. Okay. And the reason why I have all these on here is because I want you to see what types of yields that you can get in the market relatively risk-free. Okay. But I'm not trying to sell you on this. I'm trying to build up into some other things. Okay. So what you might say is, well, I want to invest in the stock market or I want to invest in crypto, but maybe I want to wait a certain amount of time. Okay, so let's say you're sitting on some cash and you're like, I want to put this somewhere, but I don't really want to put it in right now because of, X, Y, or Z. I want to wait to see how something's going to unfold first. And then after that gets resolved, then I'll come in, even if it means buying at a higher price, but hopefully it would mean buying at a lower price. So you could go and say get 1 month, right? You could lock it up for 1 month, and get a yield on that. 2 months is why I should note this is annual percentage yield, right? This is APY. This is not, you're not going to get 2.38% in 1 month. You need to divide that by 12 if you're looking at the 1 month. But this is generally what a lot of investors are looking at right now and thinking of, okay, well, let's say I want to put in some money into the market in 3 months. Rather than just sit on the cash, right? Rather than just sit on the cash and watch it lose value to inflation, you could at least get some yield on it, right? Through some of these bonds. Now, I think the thing to consider here is what is the meaning of when you see things like this? Because a normal yield curve, you would expect it to look something like this, right? Where the return goes higher as the time holding it is longer, right? So like if this is time and this is, say, your yield, you would expect this to normally be the shape. But right now you can see that the 1 year, 2 year, and 3 year are actually higher than the 5 year, 7 year, 10 year, and 30 year. And what that means is that some of these are actually getting inverted. So now I want to talk about that. So for instance, in this case, we're going to take the 2 year and the 10 year. Okay, so we're going to look at the 2 and 10 years, and this is a relatively common one to look at. So the candles here, this is the 2 year, and then the blue line is the 10 year. And what you'll notice is that usually the 10-year yield is above the 2-year yield, which makes sense, right? If you're gonna hold on to it for 10 years, then because you're taking on a longer time frame, you're putting your money in for a longer period of time, you would expect to see some type of higher yield. However, if you look closely, you'll notice there's every once in a while, you'll see the 2 year go above the 10 year. So it happened over here in 2000. You can see it happened over here as well. And then it's happened most recently. Now, I'm sure a lot of you guys already know where this is going, but what can we learn from this? Well, one of the things we can do is we can take the 2 year and divide it by the 10 year. Okay, so rather than try to look at the delta or eyeball this, we'll just take the 2 year and divide it by the 10-year yield. This is what you get, okay? Specifically, you get the candles here. This blue line you'll see on here is the S&P 500, okay? So I'll get to that in a minute. So what you'll notice is there's also a yellow line that goes across the page. I drew that for, just for convenience. It's marked at 1. So anytime the 2-year yield goes above the 10-year yield, so if you think about this mathematically, if the 2 year is greater than the 10 year, then that means it's going to be greater than 1. So anytime you see these candles over here going greater than 1, that means it's inverted, where the 2 year is higher than the 10 year. Clearly, we spend most of our time where the 2 year yield is less than the 10 year yield. But every once in a while, you will see it become inverted. And what you'll notice is that we saw a pretty clear inversion here, okay, in 2000. We saw a pretty clear inversion here in 06 and 07. And then we're also seeing one today. Now, we've also seen some sort of fake outs where it briefly goes above it and then it comes right back down. We saw that happen in 98. We also saw that happen over here in 2019. And then we even saw it happen actually in April of 2022 and also in I guess I covered. There's also some over here as well. But regardless, this has happened. This has happened a number of times. And you might be curious, what are these green rectangles I've drawn on the screen? Well, I'm sure a lot of you have guessed it. These are prior U.S. recessions. Now, the definition of recession isn't the easiest to define in terms of how a lot of people are currently defining it. A lot of times, a lot of people would just say, well, if you have 2 quarters of GDP contracting, then technically speaking, you are in a recession. However, a lot of politicians don't necessarily agree with this. And also, I mean, I know we're quick to jump, to jump the gun, especially in the cryptoverse and especially on Twitter. But there actually are a lot of people out there that I don't think are politically motivated that are also saying that we're not really in a recession yet because unemployment is relatively low. Now, the counter argument to that is that it's sort of like a fictitious type of thing where it's might be low because a lot of people just really aren't looking for jobs, just because there's been so much money printed recently and for other reasons that I'm not going to get into. But one of the interesting things, though, is if you look at this chart, what do you notice? The recession, once it was officially called, occurred after the 2-year fell back below the 10-year, okay? So you can see it happened here and here, and it hasn't happened yet over here. But in both of these cases, after the 2-year fell below the 10-year yield, we then had what, people agree now was a recession, okay? And what's interesting about that, though, is that you can see in the year 2000, the S&P 500 started going down before we really got into that recession. And one of the interesting things is that, and I've said this before, by the time the powers that be say that we're in a recession, there's a good chance that the stock market has either already bottomed or is getting really close to bottoming. Okay, this is just something we've seen. I've heard people say this a lot, and I haven't really had a lot of firsthand experience with it, but I've heard people say that a lot, and I can see it coming completely true, right? I mean, by the time people admit we're in a recession, it's likely essentially in the rearview mirror at that point. But what you'll notice is that the S&P 500 started coming down before this became, the 2-year went back below the 10-year, right? You can see it sort of topped out up here, and then over here the S&P started to come down right around the same time. But in both cases, the recession, theoretically, right, occurred after this happened. So where are we today? Well, the 2-year, the delta between the 2-year and the 10-year is actually quite high. I mean, we haven't really seen this in recent history. It get to these levels, which is somewhat concerning. And that's why I put out a video recently talking about, a hard or a soft landing. I think a lot of people are so focused on what's happening on a day-to-day time frame, but we need to take a step back and look what's going on in the macro to try to get a better sense of what's going on. And one of the things that I think is interesting here is to say, well, what would cause them to say we're in a recession, right? Well, and the reason why this is important is because once something like that happens, the Fed, which we talk about quite a bit, might be more inclined to pivot. Now, if you guys have watched me this year, I've said for the entire year, I don't think the Fed's going to pivot this year. Okay, I don't think they're going to start cutting rates. The reason, of course, is because we have high inflation. Now, if we didn't have high inflation, then obviously the Fed would very likely doing something completely different right now. But we have high inflation, therefore they are very motivated to get that under control, even at the expense of risk assets continuing to go down. So one other thing that I'd like to look at on this chart, though, is to actually overlay unemployment, okay? So the yellow line is unemployment. Again, the green is, these are the recessions, the blue line's the S&P 500, and then the candles over here, this is the 2-year divided by the 10-year yield, okay? What you'll notice is that the recession, once it was declared, occurred after unemployment started going up, okay? So you can see unemployment started going up, and then the recession was declared. Over here, unemployment started going up, and then the recession was declared. Why are they not calling it a recession now? Why do is it just political things, or are they pointing to something? Well, I think what they're pointing to, and again, I'm not going to argue. I know there's a lot of nuances with the unemployment, but they're simply pointing to this and saying, well, technically speaking, if unemployment is this low, why are we even discussing the idea of a recession, right? If unemployment is this low. But as Powell pointed out in his most recent speech, there's likely going to be some pain to come for businesses and for a lot of us. There's going to be some pain to come. And one of the ways that that could manifest itself, and I think a likely way over the next 6 to 12 months, is that we'll likely see the unemployment rate start to go, start to come back up. Okay. Now, once this comes back up, once you start to see this come back up, like you saw it happen in 2001 and like we saw over here in 2008, after that occurs and it starts really moving higher, then I'm guessing they'll likely declare a recession. Okay. But once they declare it, there's a good chance that the S&P has either already bottomed, like it did in the financial crisis, right? I mean, by the time the recession was declared, I mean, again, they do it retrospectively, right? But the S&P bottomed here. Okay, the S&P over here bottomed right there, which wasn't that long after this recession was declared. So, looking at it today, what I want people to sort of think about here is inevitably when the yield curve here, so when the 2-year goes back below the 10-year, I think there's a good chance, and I don't know how long it's going to stay up there. I mean, if we were to take a measured move here, you can kind of see over here, it took like 10 months, right? Over here, I mean, it sort of faked us out there. It took about 15 months. It could be up there a while, right? I mean, it could be up there a little while. But I think the important thing to consider is that once it starts coming back down, at some point, right, then you would start to say, okay, well, I think we're getting close to the bottom on the S&P 500. Now, I know a lot of people think the bottom's already in, right? A lot of people are saying, well, the bottom's in, it's just, we're going to start going back up. But these are the types of macroeconomic conditions that I do believe are keeping a lot of investors looking at other investment vehicles. Again, at things like the 2-year. I mean, like even the 2-year, 3.4%. Now, you might scoff at that and say, well, I mean, if you can earn 20 to 25% in the stock market, who cares about 3%? Right? Well, maybe you could earn that last year, but there's not going to be a lot of people earning 20 to 25% in the stock market this year, okay? Unless you're just really picking the right stocks at the right time. But if you're buying index funds, that sort of stuff, I mean, a lot of these things are down quite a bit this year. So that's the reason. And as long as the 2-year, I mean, as long as these yields continue to go up, all right, as long as the Fed raises interest rates, then it will be sort of a pull for investors to say, you know what? I don't want to take the risk with risk on assets right now. I would rather have the security of a bond or something where I know I can get 3 or 4%, or maybe not 4, but like maybe I can get 2 or 3%, and I'll hold it for a certain amount of time, and then once the skies have cleared a little bit, then I'll look to invest that money. And the reason they might do that is because I'm sure a lot of people here probably have, to some degree, if you DCA into the market or whatever it is, some people I'm sure have some cash sitting on the sidelines. And one idea is, well, you can at least get your cash to pull in something while you sit and wait. Okay, I hope that makes sense. I'm trying to do a good job of explaining this stuff. I haven't talked about a lot of this stuff on my YouTube channel before, so hopefully I can get better at it. But you can clearly see right here, this is the yield curve. The 1-year, 2-year, and 3-year are higher up than some of these longer ones. If you take the 2-year and compare it to the 10-year, occasionally you'll see the 2-year go above the 10-year. And then if you look at it like this, it typically leads to a recession, right? My guess is they're going to declare it a recession after unemployment really starts to go up, which is likely going to occur, either later this year or sometime next year. All right. So then that begs the question, right? Why would the Fed continue to raise interest rates when it seems very obvious that this is going to be a bad thing for the economy, right? This is going to be a bad thing if they continue to raise interest rates. They say don't fight the Fed. I think that's true. I mean, in terms of access to cheap cash, like to cheap capital, to liquidity, which is what you need in risk on markets, you want the Fed to be playing ball with you, but they're not playing ball right now, right? I mean, bear market rallies aside, right? They're not playing ball right now. So why is the Fed doing this? Well, it's fairly clear, and we've talked about this many times in the past, right? It's because inflation is so high. They just simply cannot pivot when you have inflation year over year at 9.1%. I mean, it's recently dropped down to 8.5%. We haven't seen inflation this high in decades, in like 40 years. So, people always say like, well, this time's different or this time's not different. Really, in terms of macroeconomic conditions, there's always slight differences, right? And your job is to look at everything and try to figure out, what does it mean, right? What does it all mean if you put it all together? Because, the yield curve, or the 2-year has gone above the 10-year, like it did in 2001 and or say 2000 and then like 2006 or 2007. But we also, this time, we have the issue of inflation is a lot higher. Back over here, the highest inflation got was, looks like about 5.6% right here in 2008. And then over here in the year 2000, it looked like it sort of got up to 3.75% or so. We're a lot higher than that right now. Now, the reason why this is important, right, and I'm getting fairly complex, or this chart is getting a little bit busy. So what I'm actually going to do is I'm going to go to a new chart because I can't. Let me. Okay, so let me see if it'll show it. All right, we will go over here. I will move everything. I'm going to remove the S&P 500. We'll keep inflation on there. And I'm going to switch this over to a log scale. And again, as I've said before, it was when inflation peaked, right, during the 70s, that marked the bottom, for the stock market. And in the 40s, you can note the same thing, right? That first peak in inflation, that more or less marked the bottom in the stock market. But there are some differences, right? Like you have high inflation similar to the 40s and the 70s, okay? But you also have, the shorter term bonds, like the 2-year, going above the 10-year, which is also a bad omen. I mean, it usually signals a recession. So that's why we're talking about the macro a lot more. There are a lot of issues right now that we have to get through. And that's why I keep saying, that's why I've said for the entirety of the year, it makes sense to I mean, again, it's not financial advice. I'm not trying to say exactly what's right for me is right for everyone else, but I generally think it makes sense to have some hedges against these risk assets, right? I mean, if it's cash or whatever it might be, but I think it's worthwhile to have some hedges because the macro can look pretty bleak right now, especially if you really start to dig into it. Now, again, at the end of the day, no one knows exactly what's going to happen in the market. I mean, there's always a chance that the Fed simply pivots sooner rather than later. They just sort of wave the white flag and say, you know what, we're just going to have to live in a period of high inflation, and then everything just sort of is artificially inflated, like asset prices. I don't think they're going to do that, right? I don't think they're going to do that this year, and so I think it's safest to assume that risk assets will remain under pressure for a while longer. And that's also being reflected in things like the US dollar currency index, which, continues to just sort of put in new local highs. And the dollar is I mean, it hasn't been this high since, for 20 years. I mean, it's putting in new highs this week that it hasn't seen in 20 years. So these are the macro conditions that we live in. This is why there's been a lot of downward pressure on risk assets for the entirety of the year, stocks and cryptocurrencies. I do think over the coming months, there will be more pain ahead for risk assets. Doesn't mean you can't rally some, but I do think we'll have more pain ahead. And I think the true winners of the next bull market are going to be those that had the patience and they could wait and not just YOLO in and constantly swing trade back and forth only to lose money time and time again, right? It requires a lot of patience. It requires a lot of discipline. Sometimes the best thing to do is just nothing at all, right? But I hope this has been useful. I'm sure I messed some things up in my explanations. Perhaps I gave somewhat of an ignorant view compared to people who maybe have been studying this for a much longer time than me. But hopefully this helps some people in trying to understand what's going on with the macro. How can they use that to improve their to improve their outlook on the market or figure out like they have a better handle on it. But I wanted to leave you guys with this sort of macroeconomic discussions and to also remind ourselves that, as easy as it sounds to sit here and become an armchair macroeconomist, there's always, factors way beyond our control, right? There's always black swan events that you can't predict. The pandemic was one of them, right? I mean, things looked relatively bleak back then too, and then the Fed just turned the money printer on, and they just printed our way out of it. Okay, at some point they're probably going to print our way out of this mess, but I think the thing that's keeping them from doing so is inflation's too high, right? And once inflation gets under control, they'll likely print their way out of it. But until then, I would say, have some time. I would, for me, I will continue to be relatively cautious and not get sucked into every single rally. All right, guys, I think we'll wrap it up there. Make sure you subscribe if you're not subscribed. Give the video a thumbs up. I really would appreciate you guys subscribing, trying to grow the channel as best I can. And I'll see you guys next time. Bye.